good day. Welcome again to our web class. That is for your Fundamentals of Accountancy, Business and Management 1 for your Module 3 or Week 3 topic. So at the end of this lesson, you'll be able to illustrate the accounting equation and perform operations involving simple cases with the use of accounting equation. So this is the accounting equation. Assets equals liabilities plus owner's equity. So the accounting equation formula represents the relationship between the assets, the liabilities, and the owner's equity of a business. So the value of a company's assets should always equal to the sum of these two, the liabilities and owner's equity. So the underlying concept of this formula is that every asset acquired by a company was financed either through debt or liability or through investment from the owner's equity. So the accounting equation or the accounting formula materializes a company's assets in terms of its liabilities and owner's equity. So this simple formula serves as the foundation of the double entry bookkeeping, wherein there are always two account entries made for each transaction. So a debit to one account and a credit to another. So keep listening to have a better understanding of the accounting formula basics, so its elements and its relationship to one another. First, we have here the assets. Okay, so these are economic resources owned by the company, expected for future gain, or they are property and rights of value owned by the company. So it answers the question what the company owns. Okay, this assets refers to item like cash, inventory, accounts receivable, buildings, land, or equipment. So purchasing something with the company's cash on hand will not affect the accounting equation because it's just converting one type of asset, for example, the cash, into another type of asset, the inventory or equipment or whatever else is purchased. So the accounting formula doesn't differentiate between types of assets. And for the liabilities, it answers the question, what your company owes. Okay, so these are debts or obligations, which are amounts owed to others. So this include debts, obligations to pay, and claims of the creditors and the assets of the company. Liabilities are one of the three ways in which a business can acquire funding. Okay, so liabilities can include bank loans, credit card accounts, or accounts payable, such as when a supplier offers to extend credit to a business. Next, we have owner's equity. So these are the total capital the owners have invested in the business. This include the interest of the owners of the company, claims of the owners on the assets of the company, and the investment of the owner plus or minus the results on the operations of the company. It could be you add if it has profit and you less for the loss. Okay, so owner's equity or capital comes from two main sources, the investment of the owners and earning from the company. So let's put into practice the account equation. Again, the account equation is assets equals liabilities plus owner's equity. So if the company has an assets worth 100,000 and liabilities worth 30,000, what would be the company's owner's equity? Can you guess? Okay, remember this accounting equation. Assets equals liabilities plus owner's equity. So, to get the owner's equity, you have to subtract liabilities from assets. Okay, so the answer would be 70,000. Okay, so again, if the company has an assets worth 100,000, liabilities 30,000, so the owner's equity is 70,000. So there is a balance accounting equation. So for the assets, you have 100,000, and the sum of the liability and owner's equity is also 100,000. So given liabilities of 10,000 pesos and owner's equity of 50,000 pesos, your assets is equal to 60,000 pesos. So 10 plus 50 equals 60. So there is a balance equation. So given the assets of 80,000 and owner's equity of 40,000, then your liabilities is 80,000 minus 40,000. Liabilities is, so you have here 40,000 pesos. So again, assets 80,000, owner's equity 40,000. To get a balance equation, liabilities should be 40,000. So to get the liabilities, your formula should be assets minus owner's equity. Or if you are looking for the owner's equity amount, it should be assets minus liabilities. And if you're looking for the assets, it should be liabilities plus owner's equity. So the accounting equation shows that for every debit, there must be an equal credit. So as we have already discussed, assets, liabilities, and owner's equity are the three components of the accounting equation that make up a company's balance sheet. So accounting equation demonstrates the dual aspects of a business transaction and proves that debit is always equal to credit. So here is a table to show you the effects of transactions on the accounting equation. So for example, the investment of assets by the owner. So it increases your cash, so it increases your assets, and of course increases your owner's equity. Withdrawal of assets by the owner. So if you withdraw cash, you decrease your assets and you decrease your owner's equity. Purchase of an asset in cash. So there is an increase of an asset. For example, the asset is land. Okay, you increase your asset, the land, and you also decrease your cash, which is also an asset. Next is purchase of assets on account. When you say on account, it's on credit. Okay, so your assets, it increases your assets and also increases your liabilities. The settlement of liabilities in cash, so decrease in assets and decrease in liabilities. So if you pay cash, so the cash decreased, so your assets decrease, and also your liabilities since you settle for liabilities. Settlement of liabilities from owner's personal cash. So liabilities, it decreases and it increases your owner's equity. So the following details will include the amount and the account affected in illustrating the effects on the accounting equation. Notice that the accounting equation is always balanced in every transaction, such that assets are always equal to liabilities and owner's equity. So here, let me check. Okay. Assets equals liabilities plus owner's equity. So for example, for the transaction, for number one transaction, Mr. Lee invests cash of 50,000 pesos. So you increase cash, which is an asset. For liabilities, no changes. And you increase Mr. Lee's capital. So the cash investment of Mr. Lee increases the assets of the business. And of course, the owner's equity. Next, Mr. Lee invests equipment amounting to 80,000 pesos. So the equipment increases the assets of the business, which is the asset of the business. Liability, no change. Since it is acquired, the equipment is acquired via cash. And the owner's equity increases. And this is an investment of Mr. Lee. His capital correspondingly increases. Next transaction renders 15,000 services for cash. So the business earns cash by rendering services. There is an increase in assets for the cash collected and increase in capital as revenue. Okay, so no changes for liabilities. Next, purchases 5,000 supplies on credit. Okay, remember this one. When it says on credit, it's a liability. So it is purchase an account. So supplies increases the asset of the business, liabilities correspondingly increase as the supplies were bought in credit. And for capital, there is no changes. Okay, for purchases, 350,000 land paying cash. So land increases the assets of the business. Cash correspondingly decreases with the cash paid for the purchase of land. No changes for liabilities and no changes for owner's equity. Okay, that would be all for this video discussion. Thank you so much, Annette, and see you for our next topic.